Welcome to the Dividend Talk podcast, episode 123. Dividend cuts are part of the game. Hey guys, welcome back to another episode of Dividend Talk. Today, European DGI and I will discuss dividend cuts and what we've learned from them. All that and more. See you on the inside. Yo, 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 yo. We're back on a Friday night, baby. How are you doing, European DGI?
Really good, of course, after such an intro. What do you think? Come on,
I'm pumped. I'm pumped for this one. It's been a long stressful week in work. Honestly, it's been one of the busiest weeks I've had in a long time. So I'm just excited to leave all that stress behind and talk dividends. I mean, what more can you
Yeah,
want?
exactly. Hey, and we have this podcast now 2 years, and it doesn't happen too often that we have a dividend cut, right? But we're really establishing a new tradition. So Castellum cut their dividends, so I think it's time to really drink on this. So I wanted to wish you na zdrowe, na zdrowe on Polish, or what is it? Cheers on English. And
Cheers,
I'm going to
cheers,
drink
mate.
a really ice cold vodka. How about you?
I'm drinking a drink called Jeminson's. And look, we'll salute, we'll drink, and I'll tell you an interesting fact about them.
Cheers.
Cheers. Lovely. So just before I poured that, I said I might as well. I know Jameson's a long time. It's one of my favorite whiskies in Ireland, but I never, ever, ever even thought of checking who their parent company was. They would even pay a dividend, and I'm 100% buying this company. I don't care if they've cut their dividend, just because I love it. It's my favorite drink. But they're owned by a French company called. I'm going to try to do this in my best French accent, right? But they're owned by Pernod Ricard, right, or something along those lines. Ticker symbol is EPARI, so that's the exchange, and then the ticker symbol is RI. Dividend yield is 2.2%, and they've raised their dividend every year for the last seven years, so it's quite interesting. But I don't. They're not going to be a major co-holding. I just want to support my drink. It's my favorite drink, so I'm going to.
You should just buy enough shares so that it buys you like one bottle a month.
Yeah, that's actually not a bad idea. They what's their dividend? They pay about 350 maybe. So
Yeah.
I don't know, maybe 100 shares might be enough for me.
Yeah, exactly. 100 shares, and you've got like Jameson for life of Jennison.
Yeah, but they are 185 euro per share, so maybe not 100 shares right off the bat, but I'll work up to it.
Yeah, exactly. Nice one. Nice one. I mean, what is nice, my throat is really clear now for the rest of the show. No issues there.
Yeah. We just have to rein you in there with the language when you get a drink in you. Yeah.
Yes. I hope not too many dividend cuts because before you know it, we'll be totally wasted here and drunk. And I don't want this to become an alcoholic podcast. I don't know. We have many people that are running, right? They go for a run when they are listening to our podcast, and they hear us just taking shots and drinking. Anyway,
We'll change the name to Whiskey Talk if we keep going. But hey, let's talk. There's been some news this week, hasn't there? And maybe from a European standpoint, it's an interesting turnaround. The London Stock Exchange, I think it's well known as probably the second largest after the US. Everybody always speaks about the US and then London afterwards. And in Bloomberg this week, it was reported that Paris Exchange has now overtaken that, which is quite surprising. I was surprised, one, that it was Paris, and I was surprised that it overtook the UK. But then, given all the shit show that's going on in the UK at the moment, it probably shouldn't be a bigger surprise as it was.
Well, the surprise is, of course, because when I don't know, it's probably a stereotype, but when we think about France, we think about, unions, strikes, and you think like which business can really survive there, right? So, and then to still be the largest stock exchange in Europe is it's quite impressive actually. But when you really look into what they have, right?
Yeah,
So of course we own some French stocks like Danone, but Louis Vuitton, L'Oreal, I mean, these are the powerhouses of Europe. It is of course a little bit the old industry from the old days. There's not really a lot of new tech, let's say. But I mean, credits to the French population and the government for
Yeah.
creating this economic powerhouse.
And fun fact, this was in the same article, so I haven't verified it myself, but it mentioned that Louis Vuitton is now Europe's largest company in terms of market value. I think it's worth
Wow.
360 billion. So I think that was Roche before, if I'm not mistaken.
Yeah.
But apparently now it's Louis Vuitton.
360 billion. That's huge, right? For a company, really huge. Yeah, not so many American companies that are bigger than that either.
Exactly. Yeah,
So,
it's amazing. This week we've got the World Cup. World Cup is this
mhm.
week. It's a major talking point from an Irish standpoint. I can sit back, relax, and enjoy it. Your
Mhm.
predictions. I know who you want to win, but who do you think will win?
I haven't really read up on it, but let's say the countries that I suspect to do really well. One is of course France. I mean, they have a generation that is like legendary already. Yeah, so it's just the mentality and the discipline, and then they can win. I see Argentina a bit as an outsider still. Brazil as well. I don't see them as really as title contenders like that. Maybe Germany. I mean, Germany always starts playing in the 90th minute and then they score and they win.
Yeah.
So I think we will see relatively an open tournament this time, and that many people, many teams can win, and because most of them are all kind of an outsider.
It'll be a good tournament. Germany, France always turn up in big tournaments. England are
Mhm.
quite strong. I expect
Mm.
them to do quite well. I think Argentina are the team to beat. I really think this is the strongest team they've had in the last 3 or 4 tournaments, and Brazil will be there. So personally, I would like to see a Brazil Argentina final. I think that would be amazing. But
I would love
I
to
do
see
hope
that.
England win. I'll
I would
not
love
win.
to
I
see
want.
that Messi wins. He deserves a world championship.
Yeah, not just Messi, the team in general. I mean, I think they're good all over, but the team I'd follow closely is England.
Mhm.
I don't know if I want them to win it outright. I'd like them to do well, but if they win,
Yeah,
then it's torture in the media. It's the people are lovely. It's the media. The media just blow everything out of proportion over there. But
yeah, yeah.
I do hope they do well. Yeah.
Nice.
So some dividend hikes. It's another segment that we've added. There's been some quite some dividend hikes. Nike, which we both spoke about, they dropped to about 80. I think we were both saying around the time if they got to around 70, probably close
Yeah,
to 60 for me. We were thinking about it. We were wrong. They hiked their dividend by 11.5%, and they've jumped back up over $100. So maybe we've missed a chance again. Siemens.
one day sneakers will be a little bit out of
One
fashion.
day, yes.
Yeah,
Look, it depends. It depends.
yeah,
I don't know if we've turned the corner fully yet. We'll see.
yeah.
Siemens, which is a European powerhouse, they've had a nice increase, 6.25%, I think.
Yeah, because they have their annual report, and
Yeah,
they're always around this time. So, dividend nice covered as well. So the EPS is 4.65, new dividend 4.25. So you might be misled that this is like a 90% payout ratio. But with Siemens Energy, right, it's in the book. So if this price goes down, they need to write down on that, and that impacts the bottom line here, like what Warren Buffett always says, right,
yeah,
with his holdings. So, but if you look at free cash flow, it's around 7.5 euro per share. So it's a really nice payout ratio, and yeah, you get it. I guess now for 3% or 3.5%
yeah.
yield, and we bought some both, right, at in the euro at the time.
Yeah. I got a little bit above 100. I think 101, 102. It
Mhm.
dipped below and missed the
Yeah,
opportunity. And then when it dropped again, I was making sure not to make the same mistake. But quite
yeah.
happy. I haven't read the annual report, so that's on my bucket list this week, maybe.
Mhm.
One I put in for nostalgia for me was Motorola Solutions. Motorola, one I did not know pay a dividend, but back when I was growing up, it would have been them and Nokia were the two brands of mobile
Yes,
phones that you had. It was a little flip mobile phone as well. I think it was my first.
exactly.
I think it was my first one as well. But they've hiked the dividend by 11.4% as well.
Nice. Those were those phones that if they would drop, usually the batteries would fall out.
Yeah,
Even if it wasn't the rain, you would just like wipe it and it would be clean and you would stick them together and you could use it again, right? And play
exactly.
play Snake. Play Snake.
Not like these iPhones. You drop them once and they're they're gone
Yes,
forever. You need to go and
exactly.
get. And then just a couple more. I don't know if you're familiar with OTC markets, but I'm
No.
sure if you look on interactive brokers when you're actually doing options, or they provide a lot of financial data, so you'll see them around quite a bit. They are paying a special dividend of 150, and the last one we have is Tyson Foods, which is increasing their dividend by a paltry 4.3%.
Yeah, nice. So, I love this dividend hikes. It's like just growing cash flow, right? I
Yeah,
own only Siemens from here, and I would love to own some Nike at the right price.
yeah.
Yeah.
But we're starting to see, well, the sort of a trend, isn't it? You're starting to see these top quality companies paying double-digit dividends
Yeah.
in the environment that we're in, and they're really solidifying their status as top companies. Most of these companies have sustained their share price as well, so it kind of shows you that investing in quality pays off in the long
Yes, yes, and they have pricing power and everything. But I did see this week a chart somewhere that, and it was I think around real estate, where you have kind of a pattern, and every year, like when it was, I think inflation versus housing prices, right? And there's kind
term.
of a pattern across a medium line. But then 2022 was way off chart, and that's what we're seeing now, right? Although the interest rates increased, there it's not necessarily that the retail housing prices are crashing, which is really awkward at the moment, right? So it shows still that there's a lot of liquidity in the market,
Yeah,
and yeah, we've seen it in other data as well, right? That savings accounts have been like the most ever coming after COVID. So there's still a lot of money in the market, and maybe that needs to dry up before we start seeing a decline. But for instance, they have also, I believe, already what was it 60,000 tech jobs just in the first 2 weeks of November, or almost 100,000 even. So there's a big layoff happening at the moment. So maybe these are the early signs a little bit.
yeah. Like if you remember, it was 2 episodes ago we spoke about that, and I was rambling on, maybe saying that this could be the start of capitulation. That's when I believe we'll start to see the market turning around. Since I've said that, the market has done nothing but rally so strongly. So,
Yeah, but we're just two guys talking in a pub about the stock market. We're probably mostly wrong instead of right.
exactly. But I still haven't seen that. I haven't seen that panic, that fear.
No, it's not existing at the moment.
We've seen a lot of panic during COVID, and I remember a lot of big
Yeah,
accounts. There was a lot of panic. I haven't seen that yet, and
yeah.
when I do, I'll be a lot more confident that we've reached the bottom.
Confident and comfortable that we can invest more.
Exactly. Yes. Yes.
Good, good. But it brings us maybe to the main topic of today, right? And it's about dividend cuts.
Yeah,
Because it's
and look,
part of the journey, it happens. You can do all the homework you want to do.
yeah.
At least to me, it still happens, right?
So I have to ask you. We obviously know why this is inspired. It's inspired by the recent dividend cut with Castellum. What are your initial thoughts? I know you still have to do some research, but what's your initial
I
feeling?
can tell you first maybe what happened, right? So the company announced this week that they will pause the dividend to secure their credit grade rating. And so they will advise and recommend at the next shareholder meeting to not pay out the dividend. So some people came back to me on social media saying like, it's a pause. And no, it's just an ordinary cut. Yeah, if the because who will approve it? The shareholders. Who's the main shareholder is this new guy Achilles. So yeah, what I did, I thought few minutes about it, because remember one of the shows, I think it was the last show even, or the week before, where we said like there was already a mention or suggestion that Castellum should cut the dividend, right? And here, and then I said at that time, like, okay, now is the time to think about it. So I thought about
Yeah,
it after that weekend and wrote down, if they cut it, sell it, because I don't see a reason fundamentally to sell it. Now I got a bit challenged on that on social media, saying about the debt payments and such, but I just hear the narrative of the CEO, and the thing is, I don't trust the CEO, because what the CEO had to do, had to sell his stake to Achilles, this kind of Nordic Warren Buffett, because he was leveraged to the tits with his other company. Yeah, so this and the CEO also, I mentioned a few times when I read for the first time, when he wrote for the first time the annual report, the shareholder letter, I said, like, there's something in here which is about his ego, right? So for me, this comes all down to mismanagement. I think they could weather the storm here that they are looking at too. And also, I was listening to the earnings call from Cibus today, because that's the company that I'm considering at least half of my Castellum money to invest in. It's a monthly dividend payer. And they were actually asked this question, like, about, is the dividend safe? Because there's this general narrative in Sweden that real estate companies should pause their dividends for a year and not pay them out. And they said, like, no, we're good. We stick to our dividend policy. So all of this is happening, but I have a feeling like if this CEO didn't, so the CEO brought in a kind of external exposure with his other company, where he got a margin call, or I mean, it was probably technically not a margin call, but he had to pick up cash to pay to avoid the issue there. Then I think we wouldn't have seen this, because this company had 24 years of pristine dividend growth. It has weathered the 2007, 2008 crisis. It has weathered the 2020 COVID crisis. It made a really large acquisition this year, right, with these Norwegian assets. And yes, the loan to value ratio and specifically also the interest coverage was quickly going down over the quarters. But I mean, okay, I'm not there. But for instance, today they fired the CFO. Yeah. So firing the CFO, I mean, fire the CEO. Yeah. So for me, it stinks here, and that's why I sold it, because there are also people saying like, oh, but isn't it great value? Well, I actually think it's great value. And if they protect even more the credit rating, let's say, there will be only more cash on the balance sheet, so it will only be more safer. But you know how I always look at it, in the end, I'm a dividend growth investor, and I need the passive income. If I would be now retired and I would lose 5% of my passive income, I would have an issue, with that. So what I would therefore always do is, in these cases, like Castellum, when you don't trust management, I would sell and find another company that gives me back this 5% in passive income. Yeah.
You've seen, it's not your first dividend cut, I suppose. You've seen cases where you've have mismanagement before. I recall you talk about General Electric quite a bit.
Yeah.
And do you see any correlation between the two?
No. General Electric was really visible because of the earnings. It was like IBM. Yeah. A really big gap between GAAP, non-GAAP. It was really visible. I just ignored it because I was thinking about General Electric as an institution that can simply not cut the dividend, and they're just going through a difficult time. So that was a hard lesson on here, right, on accounting effectively, and not believing what management says, but what the numbers say. But the numbers just for Castellum look good until also the last quarter. Yes, there was a downtrend, but that's what you expect with an increasing rate environment. The Moody's report I even read because of the risk that here around the interest rate, and they also said like they downgraded, but then they said like, okay, it should be good now. Yeah, so I still don't understand. I still don't buy the reason they give. They say there's a closed credit market in the Nordics. I also heard in the CBIS that is technically not closed, of course, but it's hard to sell bonds and to get buyers for that. You could go still to the bank, and have a good relation with your bank. So maybe I'm just not competent enough, in this credit market. But if I just look pure at the fundamentals that we teach ourselves as home gamers, as investors, right, to make informed decisions, then I don't see a reason. And if they then cut the dividend where it smells and stinks really what this CEO is doing, then I can't stay with the company. Yeah, even if there's value in this when looking at the current share price.
And do you think, as more, say, Western Europeans, we have less access to maybe what's going on in Sweden, unless we actively go look for it? I mean, we all get the news in the UK, the US, and to a certain extent Germany and France in your face the whole time. You don't really hear what's happening in the Nordic states
Well,
unless you go looking.
Uh,
Do you think that,
no,
like,
that's not really true from that point of view because I'm on social media. I've got a lot of followers from the Nordics, and they are DMing me all the time with updates
yeah,
about Castellum. And also now they heard me talking about Cibus on the podcast, and I get like 2-3 messages about bear cases and bull cases about Cibus. So, and we have also in our group on Twitter, we have Dividend Exe and Alan, and also on Facebook, people are active here. So. Although we don't have access in the mainstream media,
yeah,
on social media we just on Facebook as an example, and also on Twitter group, we have just amazing community that keeps us all the time informed, right?
yeah,
So everything that's happening about Castellum, we get it into our face. We just need to use Google Translate with the articles, but it
yeah,
works. Yeah.
yeah. It's good. Google Translate's good enough for me anyway. I translate a lot of Dutch, a lot of Dutch ones, particularly from the
Exactly,
tiny capitalist.
exactly, exactly.
It works. But I mean, this seems uh, unpredictable, and I suppose most dividend cuts are unpredictable. Which ones to you? I mean, Disney. That was probably, I remember Disney. That was really out of the blue. Nobody was expecting it. That one kind of hurt a little bit.
But it made sense, that the company did it because of COVID lockdowns, not having cash at all, and wanting to double down on the streaming war. So, but that's why we both sold it straight away because we knew this dividend is not coming back anytime soon. Yeah.
Yeah,
So I could, if I have, for instance, a company with 2% dividend contribution to my portfolio and they say we cut it just this year, guys, stay with us, we just have to do it to preserve cash, and then next year we will resume just to make sure we clean the bank, and we stick to the dividend growth. I could probably take it for 1 or 2 companies in my portfolio because then you have a 4% loss in total and the other dividend hikes will kind of cover it, right?
yeah,
But with Disney, that yes, the COVID was a surprise, and we saw. Yeah, I mean, we have not ever seen in our life such a pandemic, right? So, but yeah, if you're a company that's sensitive on face to face and in person business, yeah, those were all slaughtered, like the airlines as well. Yeah, so we couldn't see it coming, but it made sense that they cut the dividend at the time.
yeah, yeah. And to be fair, most cases it seems to make sense. Shell was there as well. AT&T. Look, I think they put it in the disguise of the spin-off, but I think we all knew that a dividend cut was happening, whether they spun off or not. They were just able
Yeah.
to wrap it up in the spin-off and not make it look like as big as
And that's
dividend
why
cut as it was.
AT&T was such a sour one, right? Because we just know that management is lying, and
Yes,
when
yeah,
it's so visible, then you can't stay with AT&T because otherwise you could say, you know what, I take the spin-off company or something like that. But we were just being lied in the face, and it was so obvious.
they were staring us straight in the eye and lying to us. But like, I knew we knew it was coming, but nobody was expecting to spin off when they were. That bit was
Yeah,
kept hidden. Then they just wrapped it up in that. Look, we're spinning off. We're spinning off part of the business. We're losing this revenue, and we're just reducing the dividend in tow with that. But
yeah,
that
yeah.
that
I
one kind
guess
of did hurt him.
I think I had like, was it 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 dividend cuts since 2014. So that's like 1 to 2 dividend cuts per year, which is a lot. Yeah, I know that some on Twitter had only one dividend cut, I think, in the last 8 years. And when I look at it, one was accounting fraud, simply like that. It was VRite. Former name was ARCP. But also 3 times because of a cyclical in the oil and gas industry. What was it called? National Oil Varco, ConocoPhillips, and Shell. I had like 2 spin-offs, like Siemens and AT&T, and Siemens, and then they say like, okay, the spin-off doesn't pay a dividend. Yeah. So, and this portion stays. Litigation. Yeah. So, I'm okay with this actually. Yeah, the dividend cuts happens. I know I do my homework,
Yeah.
and I want to be in a cyclical industry from time to time. Some people say like, it's just European and it's the culture. It's not true. If you look at my cuts, it's a mixture of US and Europe. I cannot say that, although generally I agree that there is a better dividend culture in America because there are more dividend aristocrats. But the companies I buy in Europe, they have also like typically 20 years of dividend hikes. And if I
Yeah.
look at my US cuts, they had the same 20 or 30 years. So yeah. But for instance, the ones that annoy me the most are things like Danone. Yeah, I believe they had like 2.8 dividend annual, and then they cut it to 2 or something like that, or 190. And I think like,
Yeah.
why do you do a dividend cut?
Yeah, it was pointless. I think we have nearly a whole show on that at the time. It kind of annoyed us a little bit, but it made no sense. And look, it was during COVID, I think, or was it just after COVID? And we know they were struggling a little bit and so
Yeah.
on. So, but I found that one hard to take. But from the list of 12 you have, or 13, whichever, which one taught you the most?
I would say Tupperware and General Electric, because, and I've acted on that, because there it was really clear that there were declining earnings, and or for an old business model that was not working anymore.
Yeah,
So where have I avoided so far dividend cuts is with Philips and Fresenius. I see there this issue as well. So although I bought them initially, I thought like great, and then something happened with the respiratory devices, as an example.
litigation.
Fresenius
Yeah,
just earnings miss after earnings miss after that. So I sold them. I expect both of them. Although Fresenius has also a really long history, they can't continue like this. They had a really low payout ratio 2-3 years ago, but this payout ratio is also going down going up with declining earnings. Right? It's just a
of course.
matter of time if they don't turn it around. So I learned the most from that. Declining earnings are really a good signal for dividend cuts. And for the cyclicals, it's kind of what I take on the chin when investing in energy. I know it can happen. Yeah, I also, for instance, in the materials sector with Rio Tinto and BHP, I'm there in it for the high yielders. I don't count on them to always grow, and I actually expect sometimes a dividend cut. So I said, and in COVID was a surprise, but other than that, no, it's really the decline in earnings that have taught me the most.
Yeah,
How about you?
yeah. So I've only had a couple. So I've had Disney, AT&T, Shell, Danone, and Tanger. Tanger outlets. Tanger outlet. I was chasing yield. That was a huge lesson to me. I chased yield. It was a high yield. It paid me for 2 quarters. Then I cut it actually suspended it completely. Share price dropped from $17 down to $5. I went, screw this. I sold them. They reinstated their dividend after I'd say about 2 or 3 weeks after I sold them. I was still salty, and then their share price jumped back up to 17. So not only did I lose a shit ton of money in what I invested, my whole premise there was chasing the yield, and it burnt me pretty bad. So that was it was a good lesson to learn, not just to chase yield. That was probably
Yeah.
a decent one. Disney was it wasn't unexpected. Well, it was unexpected, but I could understand why. But the thesis changed for me for the company, so that's why I
Yeah.
sold them. We all know Shell. We had a whole story on that, and then Danone again. It just annoyed me. The dividend cut, I didn't even see it really as a cut. It was like 1 or 2%. They brought it
Yeah.
back to the dividend from the previous year, and then to keep growing. So for me, Tanger was the biggest learning for me, not to chase yield, because bad
Yeah.
things happen.
Yeah. So for me, dividend cuts are a fact of life, right? I do study the dividend safety and such, and everything, and that's why I think I've not been burned with these dividend cuts, because one of the other things I don't have a policy of directly selling, right? Here, and that's why I didn't sell with Shell, Danone, and Bayer as an example, because they were still paying a dividend. Yeah, but for instance, I do have experience like sell quickly, because when it's especially unexpected, usually from what I've seen, at least with with the experience that I have, is that like there's COVID crash, for instance. I mean, stocks are already down. It means also
Yeah.
that many other stocks are down. That means there are lots of opportunities at attractive yields at the time. So you can get yield replacements. And then it's not like, okay, Castellum is down now. Yeah. So there's no alternative, because now Castellum is a value, but Cibus is a value. WPC is a value as a real estate investment trust. So there are other value plays at this moment in time as well, with the same upwards potential if you want to look at it from a price point of view. Yeah, but there are also just yield alternatives that give actually probably even a better risk reward than Castellum today. So
Yeah.
that's one of my learnings, that I've usually done well by when there's really such a surprise and there's no real dividend commitment, to sell quickly and throw the money in somewhere else. So with Disney, when it was at 100, I bought Chubb for it. I mentioned that before as well. I even increased my passive income with that because it was higher yielding. Disney today is $91 or something like that, and Chubb is $205 or $206 today.
Yeah.
So it just shows that you don't need to be afraid of a dividend cut. If it's like a single stock crashing in while the whole entire market is like in an uptrend and everything, yeah, then it might be harder, and you just need to probably take the loss on the chin, I would say.
Yeah. So what I'm hearing is you have quite a bit of success then when you act quickly, whether it's selling or holding, depending on the circumstances. But what mistakes have you made in and around dividend cuts? Is there anything that you've been less successful with?
Yes. One of the things I've learned now is that when a company is in a litigation, like Bayer, and they cut the dividend, here, I think with Bayer, I have this issue that it's undervalued. They still pay a decent yield, yes. So that's why I guess I stuck to him. If they would have cut the dividend entirely, I probably would have sold. So this is kind of in the middle, and then maybe I'm price anchored with Bayer. I truly believe that if they get this litigation behind them, that they should trade at double the price. I guess I'm against knowing better. I'm just waiting for this to happen. But if it waits another 2 years, just another compounder would have given me a better return. Yeah, with a normal decent compounder. So it's still more like a value play for me, knowing that I get a decent play. So honestly, it hasn't done so well for me. Tupperware either. I held on to the company after that in the first half year still, because I thought, okay, they cut the dividend, but this company, the business model was just dead. And I guess I was still thinking like, I fell in love with the CEO a little bit here, saying like, oh, Indonesia, we are going to empower all these women, Tupperware parties. And they had some good evidence in that, but still the overall business was declining. Yeah, so longing, still seeing the company as a company that it isn't anymore is also a mistake that I made. And that's why Disney was so easy to sell for me, because I had my Tupperware experience. I just know Disney parks closed, streaming, cash flow gone for the next 3-4 years. Yeah,
Yeah.
but I had to have the Tupperware learning to be able to act so quickly on Disney. Otherwise, I would have probably thought like, Disney will come back, nice company. But I can buy Disney if they tomorrow reinstate the dividend and they say the streaming wars, we have won it, we're there, cash flow has returned. I could buy it again, yeah, and then what then? I didn't lose out. I actually benefited from the whole situation to be somewhere else in the meanwhile.
Yeah. Yeah. I mean, at the time with Disney, I remember their share price nearly doubled. It was skyrocketing. There was a lot of talk around them asking our regrets. But
But
if
the
you look at it now,
fundamentals not. The
yes,
fundamentals didn't double.
and you bought Chubb, if I remember,
Yeah,
who have both paid you a dividend and increased in price, while Disney
yeah,
have followed the other growth stocks and
yeah.
tanked a little bit. So it turned out to be probably one of your better moves as well.
Yeah, exactly. So, thinking that the stock price will recover, that's probably one of those things with Bayer as an example is where I did wrong. How about you? What are your lessons learned? Like from that point of view?
Well, the big ones for me is litigation. That's why I've sold 3M. Litigation just brings uncertainty, uses up use up your free cash flow, which in turn could affect your dividend, and that's a big one for me. That's why I sold 3M. So I try and stay away as much as I can. Although I do like Bayer at these prices because I don't think it can go much lower. Whereas I think with 3M, I think Bayer is in the middle of it, and I think it's all priced in, and it's all the risk is there. With 3M, people are kind of still optimistic. It still hasn't played out yet. So if they drop to about half the price where they are, and the risk is taken, I would be there. But as soon as litigation, I come straight out because I think that's the biggest risk for the dividend cut. And that, and as I said, chasing yield is also quite a big one. Tanger is one, and you could argue AT&T was a second one as well.
So I guess to sum it up, from all the learnings, my kind of approach is sell unless there's a good reason to keep it, and this good reason should be really like fundamentals, growth, lots of growth behind it, and a trustworthy management, so that they communicated about it, that it could happen, and that they also have a plan to return to the dividend.
Yeah, if you're an engineer, an automation engineer, make your portfolio fail safe. So fail first. If dividend is cut, your automatic thing should be to cut it out of your portfolio, unless, as you said, there's a good reason to keep them.
Yeah.
Okay, no, good talk. As we said, it's inspired obviously by Castellum. I'm expecting and probably hoping probably more in-depth video article or something from you in this, and at some point, as I'm sure you digest what your learnings were. But it was an interesting chat. Okay, we'll move on to portfolio review, and we have one from Frederick. Just to give you some background, Frederick is 20 years old. Kudos for starting so young. I wish I did. He's from Norway, and there's a lot of stocks in here, obviously from the Nordic regions, which I have no clue how to pronounce or who they even are. And yeah, I'll just give you he's a nice mix of growth and dividends. So his top positions are Microsoft, 7.2%, Nordic Semiconductor, 6.5%, ASML, 6%, Alphabet, 5%, Visa, 5%, and then a whole list of Nordic companies that I don't know. What are your thoughts on this portfolio?
Yeah, what's probably also good to mention is that he feels he should have more growth because of his age, and his portfolio is therefore also set up in two parts. Like, one is technology growth companies, and the rest is a Nordic dividend growth portfolio, right?
Yeah.
I really like his portfolio. If you're 20 years old and you have Microsoft with 7.2%, your biggest position, and you've got Alphabet and ASML with 6.5%, and Visa, you're set up for the future, my friend. Low yield is maybe at this moment in time, but when you're 40, these are like cash machines. Now, of course, you cannot predict whether these companies are still so rocking it in 20 years from now, but with this whole digital transformation of everything, I think these are companies that you will really have a lot of joys from. It will give you price appreciation. It will give you double-digit dividend growth over the next few years, and then supported by a strong baseline. I mean, he has Orkla in there, 3%, right? Novo Nordisk, 3%. Castellum, so not sure what he will do with it, of course. Intel, 3%. Kone, 2.9%. So for me, this is really, except for Castellum, then now a really high quality portfolio at such a young age. I mean, he has time on his side, so the compounding, provided those companies in 10, 15 years from now are still having such track record, the compounding will be amazing for this guy.
Yeah, actually, what I do like is he's 20 years of age, okay, and he has a clear plan. I've got technology grow companies, and I've got Nordic dividend portfolio. I like that straight off the bat. The technology grow companies I really like: Microsoft, Alphabet, Visa. You could put Visa in there
Yeah.
as well. I think that's a really strong core he has. He has got some meta there as well. And actually, I'm looking at the companies, and I do know some of these. Kone, you
Yeah.
mentioned them. Orkla is there. Salamar is there. Novo Nordisk is there, and they are some really strong companies.
Mm.
I like it. I do like that. I can't really critique it too much because I don't know the Nordic companies well
Yeah.
enough in their industries and what I would suggest. If you're focused on dividend growth, as you said, I'm not too familiar with the Nordic region. I would maybe add some US companies in
Yeah.
there. As we said, they're more dividend focused than European companies and probably Nordic companies, but I don't know. But I do
Yeah.
like at 20 years of age, I do like that you have a clear plan. And I think you're right. You are young. You can definitely go for more growth over dividend. But also check how dividend growth portfolios performed over the last few years,
Yeah.
over decades, and maybe you might change your way. But I think it's incredible at that age.
Yeah. I mean, when I was 20, I was only playing with girls, of course, at an adult age. And I can tell you the only thing I wanted is that they wouldn't grow. Yeah.
Yeah, yeah, yeah. Yeah, nice. No, a nice portfolio. And actually, it's nice to see something different. I spoke last week,
Yeah,
and
exactly.
I got challenged and said we see a lot of the same, and this is something completely different to what we've seen before. It's quite refreshing and nice, and actually reminds me of some really good Nordic companies like that we should
Yeah.
be looking into.
Yeah. Good. So,
Okay.
Fredrik, good luck with this one. I think you will do well. Send us a message in 10 years from now when you're financially independent and traveling the world.
Nice. We'll move on to some listener questions now. And the first one on the list we have is from Toby. And he's asking, which stock in your portfolio are you closest to selling at the moment, ignoring Castellum?
So generally none. Yeah, but if you ask me which one do you feel has the most risk in your portfolio, or do you feel a little bit unheimlich with? I would probably say 3M with the litigation. I have a feeling that is too much for them to be able to cope with.
Yeah, for me, it would be Orange. I spoke, it's a
Mhm.
short-term play.
Yeah,
And look, I don't expect them to, but if they were to cut the dividend, it wouldn't be the biggest surprise in the world.
yeah,
It is kind of a cyclical environment they're in as well. So that would be one I would
yeah.
be closest to selling. Beatrice, what risks do you see?
Mainly that, for instance, they are transforming right with their portfolio, that they are transforming into an area, into a market like ophthalmology, where they are not able to secure cash flow, and therefore that they, for instance, are selling current free cash flow, not replacing it with new free cash flow, and therefore get into trouble with paying down their debt. That's the main risk I see. So far, they've been successful with that because their free cash flow numbers are really excellent. But that's the big risk, and that's why I think it's priced at a 6 PE. How about
Yeah, no,
you?
I agree. I think the balance sheet is fragile, I would say. But what is keeping them going is that they generate a lot of free cash flow. As you said, they are moving into different areas, which if not successful, could eat into that. And then
Yeah.
look, we all know high debt is not good for dividends. So
Yeah.
we'll see. We'll see. Pablo has said, I've just sold my favorite Bats British American Tobacco. I took advantage of the recent top and will be buying back in over the next couple of months. From what I can see, the stock markets are on a downward trend at the moment. I've just taken 1 year bond, 4% on capital at a bank. So 6% yield on Bats, while still attractive, comes with higher risk to capital.
Yeah, I don't care so much about my capital because I invest for passive income, and this will do the compounding for me. So for me, this is a bit like timing the market, which is a little bit against my philosophy of investing. I mean, it might be
Yeah.
a really wise decision if now the stock market tanks, then he will be the hero. But generally, I try to not do that because I have no clue what the market will do. I'm with you that my gut feel says that we have yet to see the worst. But yeah, I'm not selling before because of that. Some of my I'm not selling Microsoft for that now and take all the profits and then think like I will grab it back at 200 or something like that. Yeah, next year.
Yeah, yeah. I mean, what I can tell you from my own experience is that I've tried this a couple of times. I've tried it with ADP, automatic data processing. I bought them at 113. They jumped to 180. I thought that's the top, and sold them. They're now at 256. I also did it with someone like AOS as well, if I remember. And there was one more I can't remember. Every time I've done it, it has gone in the wrong direction. And I actually thought about doing the same with the likes of when Johnson Johnson and Texas Instruments didn't drop with the whole market. I thought it was inevitable that they would. I was tempted. Thank God I didn't, because I would be wrong again. So every time I've done it, I've thought about doing it, I was always wrong to sell. So if you're selling just because you think it's the top and it will drop, for me, I think that's the wrong reason to sell. But I hope it works out for you if that's the case. But I would say from my experience, very rarely it does, unless you're a better trader, and maybe you are more of a trader than I am.
Simon Stott, he's asking you about whose portfolio is doing better so far this year, yours or your son's?
Yeah, so it was my son for a long time. He was whooping my ass, but he's got Tesla, Meta, Roblox. He's got some of those companies in there, and they're hurting him pretty badly at the minute. He's still doing quite well with his other portfolio. He's not down, so his portfolio is up, but I am kicking his ass this year. So, when he listens to this, you should listen to this old man. You'll do okay.
Nice. Nice. And then Chuck Mariolis, he says he has a couple of stocks that have become very low yielders due to price appreciation. What do you think about selling out of the money calls on these to bump the yield? Example, Nucor, 1.5% yield at the moment.
But they're low yield because of price appreciation. But when did you buy them? Like, your yield doesn't change. If you bought them at a 3% yield, you'll still have a 3% yield if they have the same dividend. So it's yield on cost. Yeah. So it's yield on cost. So I mean, I think it depends on if you're only buying at a low yield, it's not a bad idea if you're willing to sell that company. Because
so how I take it, the price doubled, let's say, in the meanwhile since he bought it. Feels probably it's overvalued. You could do some covered call selling, right? If you have 100 shares in that, and if you don't mind that they get called away, and you would then buy it for something else, why not? It's a bit of a more advanced strategy, I would say, not for the faint at heart. And sometimes you might get called away. So if I would do such things on not on my core stocks. So I have like 10 stocks that are really my foundational stocks, my tier 1, but I could do it on tier 3 and tier 4 stocks, right? That I know that if they get called away, I will be okay. I will buy something else there.
Yeah. So I usually do it around companies like Altria, because they hover between $40 and $50 and stuff like that. But again, I would not do it with the likes of Microsoft or stuff that
Johnson Johnson, Realty Income. Yeah,
because what will happen is that you get price anchored. We speak about this quite a bit, but it's natural. You will be after buying them for, say, $100, get called away for 120, and they're now sitting at 180. You'll be price anchored at 100, and you won't buy them back. So
exactly,
you just have to weigh up the risks. But if you're willing to let the company go, then by all means sell cover calls. I think it's not a bad way. But remember, it's yield on cost is what you should focus on here.
Yeah.
Salim, any thoughts on Vale SA? They have a good yield, or would you rather Rio Tinto or someone else?
Well, at the moment they have a 9.5% yield. I guess it's also because of special dividends. I haven't checked it out. A PE ratio of 3.6. I'm seeing here. 30% up since the start of the year as well. So look, I have got already Rio Tinto and BHP. Vale has some good assets. So from that point of view, it could be a nice company, but personally, I'm not interested in it. I prefer Rio Tinto.
Okay. Dividend Yogi has sold his holdings in Castellum due to the dividend cut and is building a position in Home Depot. What's your opinion on Home Depot?
Well, we spoke before that about this on the podcast, right? It sounds to be like a creme de la creme for the home gamer there in America, but I don't know the stores. I've never seen them. I checked the other day Hornbach, yeah, which is a Northern Europe German kind of equivalent of Home Depot. So I only hear good stuff about it, but I just don't know their business, their brand. So I find it hard to invest in it. And also valuation, every time I look at it, it's really high valued.
Okay. Dave S has asked us top European investment holding companies that pay a dividend. I had to Google the top 10. I only knew of one, which was the Swedish one I think you spoke of before, Investor AB. But there is a couple others.
Yeah, so Investor AB, right? It's an iconic one. It has a holding in ABB, SEB, Hooksvara, I believe. How is it? Also in Electrolux for these vacuum cleaners and such. But also Halma PLC, so ticker symbol HLMA on the London Stock Exchange, and it invests in life-saving technology companies. It's part also of the Noble 30. This Halma is a company I would love to have one day, but it's always overvalued in my opinion. Those are two really, in my opinion, top-notch holding companies in Europe.
Cool. And then Dave has a second question about a recommendation on a consumer staples defensive European dividend growth company.
Well, I'm generally a fan of Ahold.
Yeah, I mean, I've got three of them in my portfolio: Ahold, Danone, Unilever. And if I was to pick off the three, I would pick Ahold. So that's what we choose.
Yeah. So how much does stock buybacks influence your purchase decision?
I don't know if they influenced my decision a whole lot, but you definitely consider them. They are important. But I think he mentioned Meta there. For me, it's not a defining factor whether they do or don't. It's not something I will base my full decision on. But I still like to see that shareholder yield, which is both dividend and shareholder buyback. So I do consider it, but how much I would say I would weigh it maybe 5 or 10%.
Yeah, for me, it only when the company is clearly undervalued and the CEO seizes the opportunity just as much as I do, and they don't leverage up to the tits, then yeah, then I can take this into my decision making. Actually, it turns me off when I see buybacks at high share prices, high valuation, let's say, and then using debt even for like Starbucks did until Howard Schultz came in. That's why I didn't buy Starbucks until then.
Okay. And the second question then is on Castellum, any thoughts on why the price hasn't crashed?
I have no clue. Maybe it was already priced in.
No, my thoughts around that is that you've mentioned this guy is like the Warren Buffett in the Nordic part of the world. Could you imagine if Warren Buffett had bought a company in Europe or the US, even if they cut the dividend, that price is not crashing?
Yeah, true. There's a lot of branding into it. Yeah,
it probably has a lot of branding and probably a lot of clout and a lot of respect, and people might think that he will actually do a better job, and the company may.
Yeah, and the company is undervalued, right, by all metrics. So yeah. Okay, then yeah, go on.
Jesper, a lot about Castellum. I think that's a reply to the question above. Actually,
exactly.
We'll skip that one. L Dev H, thoughts on Beatrice? Will they be able to decline its debt
we just
in the
mentioned
future?
about that same answer. Yes, I think so. As long as they are able to continue having this cash flow.
Yeah, I mean they've reached the 12-month target within 9 months this year. So
they are under promising, over delivering over the last 2 years, right?
Yeah.
That's important to mention. And this is what we see with Ahold as well. I like such management. I know that some people look at it as old Pfizer management, not trustworthy. so far the last 2 years, I see other things. Yeah, I see that they're trustworthy. The only thing that surprised me was them selling their biosimilars. It was not in their plans. That was kind of like, huh, what are they doing now? But other than
Yeah.
that, they've been under promising, over delivering.
Yeah, I mean, we've seen something similar with Shell in terms of debt reduction.
Yeah,
They used to do the same. They used to say, "Oh, look, we're going to pay back 2 billion," and they pay back 3 billion. So it's
yeah,
always encouraging to see. And I'd rather them do that than
yeah,
over promise and under deliver.
yeah.
Fire Moan, do you guys think all companies you have are true sleep well at night, or few are deep value traps?
Not all of them are true sleep well at night. I wish it was. Most often, the majority of the companies I buy are at that moment in time sleep well at night. Think about 3M. Until shit hits the fan, 2 litigation cases, multi billions at risk, and you don't sleep well at night with that stock. So it's at the buying decision. It's an important factor. I would say Viatris is not your typical sleep well at night stock. Intel neither, but they have a certain percentage of my portfolio which is contagious, right?
Yeah. I'm similar. Not every one of them are sleep well at night. AT&T, Orange, even Walgreens, I would put in there, and Intel as well. So there's quite a few that are at risk, but then you, as you say, risk and reward, isn't it? There's a reason why
Yeah.
they're in deep value. So there's always
But
that.
most of them you bought thinking they're kind of sleep well at night as well at the time, right? Maybe not with Walgreens, but I guess AT&T when you bought, was it
Yeah,
before the dividend cut? Then it was like, why would they cut it?
AT&T were what, 50 years. They were dividend king at the
Yeah,
time, and
yeah, exactly.
you just never thought that they would cut it. Intel haven't cut it, but we do know
Yeah.
the risk there.
But
And
for me, Castellum also at buying was a sleep well at night stock.
where are we? So Jasper, what are a few good companies on your watch list that are tempting valuation right now?
Yeah, so I still haven't finished my analysis, but Cibus is really one that is tempting for me as a replacement for Castellum. And yeah, I'm still thinking about realty income to add few more. Texas Instruments, it's still at a decent. Texas Instruments is like a high quality company at a fair price, and realty income as well.
Yeah, I'm looking at HPQ again. I still like them.
Yeah,
CME Group is another one that I am looking at. They have a 2.3% dividend yield, but they have a solid history of paying special dividends, which is not factored into the yield. So that's one I'm looking at. Who else am I looking at? Beatrice, I think, is undervalued, but I still have 200 shares. I don't really want to go too much, but I still think they're grossly undervalued as well. And Intel are on my list.
yeah.
Okay, and the last question is from Gordon, and apologies we didn't get to this question last time, but he has asked us, do you think low-yielding stocks like Apple, Microsoft, AMSL will contribute their yield by realizing capital gains to your financial independence?
So let's say like that Apple and Microsoft are contributing by yield on cost. Let's say like that, because my passive income from it is quite I'm quite happy with that one. But let's say as an example, ASML, one of my latest contribution. It's just such a quality stock that I would like to have it in my portfolio, but I don't expect to live on to really meaningfully contribute to my passive income at the time of retirement. So I guess capital appreciation then, or maybe after 10 years of living off dividends, that it starts to become meaningful. But I mean, I believe I own one share in ASML, so it's more like for me like compassion for the stock than anything else. So
yeah. I really don't bank on it or think of it in that way. If it happens in 20 years and I'm retired and I have Microsoft and it's whatever, €2,000 at that stage per share, sure, I'll be happy, but I don't count on it. I just count on what I know now, which is the dividends and the expected dividend growth. That's what
exactly.
I try and base my decision on.
Good. That was the end of the show. This was the last question.
Yeah,
So.
I mean, quite a lot of questions. Again, as always, thanks to everyone for asking the questions, both on Twitter and Facebook. I do have to say we have to start getting our reach out there a little bit, like us on Facebook. We're trying to get some big guests on the show, and some of the response back is that we need more reach. So let's try and push it as much as we can, and we might get some big guests on the show.
Good. Thanks again for the show today, and I wish you a great weekend, and to all our listeners as well. Keep on running. Have a good weekend.